So is there a Santa rally coming around the corner for stocks? Maybe not, but never mind. Here are the stocks that you need to be watching. My name's Jessica Amir. It's great to have your company on this Monday, 24th of November. Before we get into the thick of it, let's cover what you need to know about markets. So we are seeing US stocks attempt to rebound. Well, they did attempt to rebound on Friday, but overall it seems investors, they're not convinced. So we did see the Aussie share market fall by 2.5%. The US benchmark index, the S&P 500, fell 2%, but Hong Kong's market was smashed. It fell 5.1%. Overall, what you need to know is that investors are dealing with AI anxiety, there's concerns about crypto leverage, and of course, delayed US government data coming out is dampening US rate cut hopes. And the overall concern is that this week's deluge of data being released, it could rock the boat even more. What's on tap? Well, in the US, there's GDP or economic growth data, and of course, US inflation numbers, CPI, and Aussie inflation is also out, CPI. It's a shortened week in the US. What does this mean? Well, it means that moves could be more volatile, and this is usually what happens when we have lower trading volume, basically meaning less trade. So moves in either direction could be amplified. And the reason I'm saying this is because we still have the market's fear gauge, which we track on Moomoo via the VIX, of course, that's still sitting pretty high. And when I say high, it's at a reading of 23, and that's one of the highest levels that we've seen since the April-March market crash. This basically tells us when we see the VIX or fear gauge is high, sophisticated investors are still on edge about where markets could go over the coming 30 days. So maybe we should be on edge if sophisticated investors are too. But what if, playing devil's advocate, what if data swings in favor of rate cuts and markets kick off a late Santa rally? Wouldn't that be nice? Yes, it would. But what you need to do is just focus on what's important to you, regardless of what is happening in markets and regardless of the noise. That brings me to a consideration for today, and that is to look at airlines, usually a very volatile sector. So why am I talking about them? Well, good question. Americans are heading off to Thanksgiving holidays. Aussies are starting to think about holidays soon as well. So keep an eye on airline stocks. And today I wanted to kick off by bring in a couple of US airlines. And this is because Americans are planning to spend a record amount on travel this year, with 81.8 million Americans planning to travel from November 25, that's tomorrow in the US, right through to December 1. So that'll be an increase of 2 million traveling more than there were travelers last year. And you've just got to wonder, with the oil price being down this week, and across this year, maybe it's time to start looking at Americans' preferred airlines. Just call out a couple: American Airlines, United, and Delta. Historically, do note that they have actually performed strongly in comparison to their usual trading months. They usually do quite well over this period, or they have done over the past 10 to 20 years. By contrast, Australia's airline Qantas has not done so well over this stretch of time. But the question is, should you be looking at Virgin, given they recently listed? Will they buck the trend after debuting back on the ASX this year? Will a tailwind be that they've got non-stop flights from LA and San Francisco? Will that bring appeal? I don't know. It's something for you to consider. Webjet is reporting today in Australia. EasyJet, ESJY, is also reporting on Tuesday, both, of course, tradable on Moomoo. But you should get a guide on how airlines are faring, how much consumers are feeling about traveling. Are they seeing increased optimism? And are airlines themselves benefiting from that 15% drop in oil price, which is a tailwind? So EasyJet will be one for you to watch, but do think about how can you get an easy exposure to airlines. You could have a look at the Jets ETF, but don't have a look at that over the past year. It's been up and down like a yo-yo. It's worth noting that airlines, as we're saying, that they're usually very volatile, but we do have some outliers that have rallied throughout history. Qantas is one. It's gone up 75% over the past 5 years. United Air, a popular carrier in the US, it's gone up by 133% also in 5 years. Let's move to stocks to add to your watch list. Let's kick off with Virgin. Remember that one? So when they listed on the ASX, this chart really tells us and reflects how volatile airlines are. So this is a story in itself. Maybe airline stocks are not good for investors, but maybe the trader with thick skin who knows how to trade and look at charting patterns can look at airlines. The fact that Virgin opened on the ASX at $3.12 when they started trading 5 months ago, happy anniversary to Virgin, by the way. So they started trading at $3.12. They rallied up 21%, popped to $3.80. That basically shows gains were there on offer for traders, but then they crashed. They fell into a bear market, losing 21%, and they now trade at $3.01. So maybe it's not a stock that you want to marry and pass down to the grandkids, but maybe it's a stock that you may want to think about potentially trading. Why? Well, their RSI, relative strength index, is actually at 25. That basically indicates it could be oversold, and maybe, just maybe, it's due for a rally. I don't know. I'm just calling out the RSI, but do keep an eye on that. Let's change pace with Christmas shopping in mind and company earnings continuing. We hear from the Chinese consumer bellwether Alibaba. They report on Tuesday, and so too does the Chinese jewelry company Chitao Fook, also reporting Tuesday. What do you need to know about Alibaba? Well, they fell like a stone last week, but their shares are doing pretty well, up 84% so far this year, and they are rated a strong buy among analysts. Think about other popular Chinese brands that are doing well, also here in Australia as well. We've got the fast-growing online retail platform Pinduoduo, or PDD. Temu is gaining a lot of popularity with Australians and those turning online for Christmas. This maybe is a stock to add to your watch list. They traditionally, throughout history, have seen strong returns from November to December. So that's a stock to consider as well. And don't forget the local favourite, JB Hi-Fi, that traditionally sees one of its strongest multi-month gains from November to February. And again, that's just looking at the history books. Let's change pace. Last but not least, let's end on a new trillion-dollar titan, and that is Eli Lilly. Eli Lilly has become the first healthcare company to join the $1 trillion market cap. It's one of the favourite up-and-coming healthcare drugs, and it's driving a healthcare revolution right alongside Novo Nordisk in the obesity market, with industry sales expected to hit $150 billion by 2032. Eli Lilly is loved by a lot of investment analysts. Well, that's the consensus. It is rated as a buy. It was reiterated as a buy by Bernstein and Citi last week. And overall, it's rated a strong buy among analysts, and their shares have done well this year, up 38%.